Understanding a balance sheet is like learning a new language. It's key to knowing a company's financial health. Today, let's break down what a balance sheet is, why it matters, and how you can use it to make informed financial decisions. What is a balance sheet? A balance sheet is a financial statement that shows what a company owns, what it owes, and the net value for its owners or shareholders at a specific point in time. The balance sheet relies on a simple formula. Assets equals to liabilities plus equity. Everything a company owns, its assets, is funded either by borrowed money, called liabilities, or by owner investments, known as equity. Why is the balance sheet important? A balance sheet isn't just a report, it's a tool for assessing financial health. Here are the top reasons why it's crucial. First, it lets you quickly assess financial health. When assets are higher than liabilities, that's a good indicator of stability. Second, it reveals potential financial risks. If a company has a high debt load relative to its assets, it might be vulnerable. Third, investors use it to decide whether the company is worth their money, checking things like liquidity, risk, and growth potential. And finally, for business owners, it helps track changes in assets, liabilities, and equity over time, revealing growth patterns. Key sections of a balance sheet. Let's break down the three main components: assets, liabilities, and equity. 1. Assets. These are what the company owns. These include cash, inventory, and long-term investments. Current assets, like cash and accounts receivable, can be converted to cash within a year. Non-current assets, like property or equipment, are long-term and expected to provide future benefits. These different types of assets give us insight into how the company generates revenue and plans for growth. 2. Liabilities. It represents what the company owes. Current liabilities due within a year include accounts payable and short-term debt. Non-current liabilities, like long-term debt or deferred taxes, are obligations due after a year. Examining liabilities helps assess the financial obligations the company faces, both short-term and long-term. 3. Equity. It is the remaining value in the company after liabilities are paid off. In a sole proprietorship, this would be the owner's capital. In a corporation, it's the shareholder's equity, including common stock, preferred stock, retained earnings, and treasury stock. Growing equity over time often indicates profitability and reinvestment, which is generally positive. Common balance sheet mistakes to avoid. Now, even small mistakes on a balance sheet can lead to big financial problems. Here are a few common errors to watch out for. One mistake is omitting liabilities. Companies sometimes overlook long-term debts or deferred taxes, but all liabilities should be included. Second, avoid overstating assets. Assets like machinery should reflect their depreciated value, not their original cost. Third, don't misclassify assets and liabilities. Incorrectly listing a long-term liability as short-term or vice versa can skew liquidity ratios. And lastly, don't ignore off-balance sheet items like certain financial obligations that may not appear on the balance sheet but are still relevant, such as operating leases. How to read a balance sheet. Reading a balance sheet doesn't have to be overwhelming. Let's simplify it in 3 steps. First, start with the assets. Look at current assets like cash and accounts receivable for liquidity insights. Check out long-term assets, like property and equipment, for clues on future growth. Second, examine liabilities. Look at the ratio of short-term to long-term debt. If the company has high short-term debt, it could be a sign of financial strain. Finally, review equity. Has it grown over time? Increasing equity usually points to a profitable company that's reinvesting in itself. Key ratios for balance sheet analysis. For deeper analysis, there are 3 main ratios you can use to get a clear picture. The current ratio measures a company's ability to cover its short-term liabilities with its short-term assets. The formula is current assets divided by current liabilities. A ratio above 1 generally means the company can meet its obligations. Debt-to-equity ratio reveals how much debt is used to finance the company compared to equity. The formula is total liabilities divided by total equity. A lower ratio often indicates stability, while a high ratio may suggest the company is too reliant on debt. Return on equity, ROE, shows how effectively a company uses its equity to generate profit. It's calculated by dividing net income by shareholders' equity. A higher ROE means the company is using equity efficiently to generate returns for its investors. Tips for reading a balance sheet. Here are a few tips to make balance sheet reading more intuitive. First, compare balance sheets over time to spot trends. For example, if assets have increased and liabilities have stayed steady, it may suggest the company is growing without taking on more debt. Next, analyze in context. A balance sheet isn't the whole story. Always compare it with the income statement and cash flow statement to see a complete picture of the company's finances. Finally, use industry benchmarks. Comparing balance sheet ratios to industry standards helps assess competitiveness and financial health relative to others in the field. Balance sheet analysis checklist. When analyzing a balance sheet, here's a quick checklist to guide you. First, review current and non-current assets. Ask, are they increasing over time? Is the company holding too much or too little cash? Then examine liabilities. Are they mostly short-term or long-term? Is there enough in assets to cover them? For equity, check if it's growing over time. This could mean the company is retaining profits and reinvesting in its growth. Finally, assess key ratios. Is the current ratio healthy? Is the debt-to-equity ratio within industry norms? And compare these findings with past balance sheets. How has the company's financial position changed? Common balance sheet mistakes to avoid. Now, while balance sheets offer valuable information, it's easy to make mistakes. Here are some common pitfalls to avoid. First, focusing on just one section won't give you the whole picture. Look at assets, liabilities, and equity together. Next, don't ignore off-balance sheet items like leases or pending lawsuits that impact financial health. Also, don't skip comparing with other financial statements. A balance sheet is just one part of a bigger picture. So, a balance sheet provides essential insights into a company's financial health. It's a critical tool for investors, business owners, and financial analysts alike. By understanding how to read and analyze a balance sheet, you can assess a company's liquidity, financial risk, and stability. Remember, a balance sheet captures a snapshot of a company at a specific point in time. To get a complete picture, compare it with other financial statements and look at trends over time. With this knowledge, you're well equipped to make more informed financial decisions. If you found this breakdown helpful, don't forget to like, subscribe, and leave a comment. Thanks for watching, and we'll see you in the next video.